All right, welcome back to the Blue Sense Pod. I'm back on with Nathan for a short episode this week. I wanted to catch up and talk about, really just sort of finance in general, but specifically how we think about cash flow versus profit. Um, I think the narrative in agency landscape is becoming more and more common that brands, agency brands specifically, are talking about, we read your P&L, we're grounded in your P&L. It's certainly something that's been really a foundational piece of Blue Sense's philosophy since day one. But the quality of execution can sit on a pretty broad spectrum there, obviously. And I think then sort of the next iteration of that, if you will, is it's actually very easy to get sort of lost in a P&L and not be mindful of where a brand is at with their current cash flow, with their inventory holding. And if they get too far out of whack on that, it's like you can actually be a really profitable brand on paper in your P&L and still go broke. And so it's important to have a bit of a conversation about that. And so just to get started, let's start with just, what's the sort of core philosophy there? How do we need to think about this? And what are maybe the top couple of things that we should be looking for in a brand, or that a brand should be thinking about when they're addressing this conversation with their agency?
Yeah, cool. I think to set the scene, the crux of this conversation really is that a brand can be very profitable on paper, but then go bankrupt at the same time.
Yeah.
And the reason for that is, unfortunately, the e-commerce model is worse than the agency model in terms of free cash flowing, because you have to take your profit most of the time and reinvest into buying inventory if you're a growing business. That can also be the case if you're not a growing business, but you're launching products that fail. And so you end up with a bunch of inventory on hand. This can be very common in fashion. This is like the fashion death spiral, which is that if you start to go out of trend, you start to make products that people don't want, you end up with a bunch of inventory on hand and you can't sell it. And so you might be making money on paper once again, but you're just losing all of that cash. So I think where to start here is that the connection to the P&L within marketing is something that obviously a lot of people are using in their external marketing as agencies. And I think that the broad sweeping application of that messaging really is just, we will look at your daily profit number and we will make decisions in Meta and Google. And if profit goes up, good. If profit goes down, bad. And that is the extent of, we have marketing driven finance. Now that obviously starts to fall apart when you work on like 8-9 figure brands, because there's so many confounding variables that move the bottom line profit number on a day-to-day basis that sometimes, most of the time, it has absolutely nothing to do with marketing. And so actually being able to just discern that measurement out becomes very complex. And that's where there's, as you said, this very big, broad spectrum of like, we just look at the daily profit number and that says good or bad, versus actually having a nuanced understanding of how to connect these things properly and not make decisions using the wrong data sets. Where this goes a step further is obviously in understanding cash flow requirements in the business. And so specifically, what is important for an agency to have visibility on is inventory on hand. How much inventory is on hand in each region across each core SKU. The reason it's important is because multiple times, we could say case studies, but I don't want to name drop brands, but there's been multiple times where we've clearly identified that the client is under financial pressure because they're using financial instruments to be able to continue to buy inventory for future sales periods. But when we look at our P&L and our internal software that tracks daily profit, we go, how is this even possible? These guys are printing money. Like, why are they taking on loans? Why are they in this distressed position? And why are they suddenly saying we can't have a 5x MER, we need a 10x? And it's like, well, wait a second. We're very profitable where we currently are. What's going on? And what's going on is that there's one or two core products that have been not selling through well. And so there's $2-3 million sitting in inventory in those products. And yes, they might have done $2-3 million in profit over the course of the last 5 months, but that's all now just held up in that stock. And so there isn't actually any cash available in the business. And so in those circumstances, as an agency, and what we have applied multiple times is then looking at offer curation and spend distribution into those particular products to turn it back into cash. Because there's a decision that you have to make, which is, do we continue to have the highest MER possible and have profit look good? Because that's, if we're just looking at daily profit numbers, up equals good, down equals bad. Okay, we should probably just go up. But that would probably cripple the business in this instance. And the better decision would instead be to actually distribute media spend into the bad product that no one wants, but we have to move it at like a 2x MER, break even probably, maybe it's a little bit negative, but we go and then turn $3 million in inventory back into cash.
Yeah.
That would be the much better decision for the financial stability of the business. But if you don't have visibility into inventory, you can't make those decisions. And if you're not having those discussions with your agency, they can't have visibility into making those decisions. It's also probably worth caveating that this kind of discussion with your agency isn't even worth having if they don't understand that concept, right? If you just say, this product we're overstocked, go and push it at a 2 ROAS, I don't know, the strategy might fall apart if they don't understand exactly why they are doing that and what the objective is, how we're measuring success out of making a marketing play like that, which is very much so balance sheet focused. So
is it, and not to go too sort of off topic there, but like, is there a conversation that needs to be had around how that fits into where that stock might sit in your paid media strategy, in terms of, is that like, are you just going to chase aggressive, potentially slightly unprofitable acquisition of new customer for that stock, or you're trying to liquidate that into returning customers, again, potentially at break even or slightly at a loss? Like, because I can imagine like that gets confusing then if like you turn around and chase that activity, but you do acquire a bunch of new customers. It's like, well, hey, like that category of that product line, we've suddenly got these new customers that seem engaged in the brand. Like, how does that confuse the model more?
It depends on the strategy of the business, but generally, this doesn't always apply, but generally, if you get yourself in this position, you start with email first, and then you move to organic social, and then you move to paid. And so you're really trying to clear the inventory for the cheapest cost possible. And so you're going to start at your free direct communication channels, and then you're going to move into paid as a last resort. Some people would argue to do the opposite because they don't want to ruin their list with a terrible product that no one wants. So that's going to be like a personal decision. Same thing with organic. Like, the way that you push a bad product on organic is you get someone going, this is my favorite product that we have. Like, I love this product. You should, and it's like a little bit insincere because it's probably not that person's favorite product if no one's buying it. Yeah. But so once again, it's like, what do you want the branding and perception of your organic content in your emails to be? If you're fine with just pushing poor products to move the inventory at the lowest cost possible and then moving up to paid as a last resort, that's probably the best pathway.
Sure. I think then there's also a question here around category. Now you've mentioned fashion. We talk about fashion on this content a lot because it's a big part of our portfolio. I wouldn't say it's over 50%, but it's a big chunk. I think when you get into like hard goods, not so much consumables. Like consumables, I feel like if you've got great retention metrics, you're less likely to find yourself in this position. Not always, but that's a little bit of a different conversation. But if you've got I think those sort of like hard goods single product businesses are the ones where this can become a really important conversation, because there's a lot of businesses in that space that are riding a trend as well. And so how do you then think about that when it comes to, are you chasing a new product development? Are you chasing a just raw profitability? Like I speak to a lot of single product businesses. They're like, my growth pathway is a new market, for example, which can be a whole different P&L conversation on its own that needs pretty serious cash flow to fund. So how does that change things?
Yeah, I think this is actually really timely for single product businesses because you don't have the issue of the grade C or grade D inventory. So for those that don't know that terminology, you can rank inventory based on sell-through rates into A, B, C, D. And obviously D, terrible, A, very good.
Sure.
And I believe Shopify will do this for you automatically as well, based on your sell-through rates. you don't have that issue because you only have one product. So hopefully it's grade A because there's only one big dent there. The issue there is in misplacing inventory, like POs, against the forecasted revenue. And so why I said it's really timely is because people may have over ordered for November, December, and now in Jan, and I actually know a couple of businesses that are in this position, they're very cash flow tight because they either over ordered inventory, and so they've turned too much cash into inventory, and now they're in the worst sales period of the year, and so they can't convert it back, number one. Or number two, just the cash requirements to be able to buy the inventory for November and December and then fuel the ad spend required using financial instruments. And now they're paying down those loans now, which also puts them in a very stressful position if they didn't hit MER targets or whatever it might have been during the period. And so it's important for the agency to have visibility into, once again, the inventory on hand, because it will change the efficiency targets for Jan, Feb, March. And this is really why like visibility over the P&L for a marketing team is critical at all. And this is why internal teams can break down when they have like an in-house marketing person and a media buyer and then a CFO just giving them budgets, because the internal marketing team normally isn't upskilled enough within finance to be able to convince the CFO of these things, and the CFO isn't upskilled enough in finance. And so it's like two very different worlds trying to match and drive the business in the right direction, but there's no middleman to actually bridge the communication. And this would be a really good example of it, because what happens? Let's run through this scenario. Jan, Feb hits. There's a ton of inventory that we didn't sell through in November, December. CFO goes, oh my God, we need a bunch of cash. We need the net profit to go up. We're going to cut media spend because we need to make more profit because we have no profit. We have no money. Goes to the marketing team and goes, we are cutting your marketing budget by 40%. It's gone. And then the marketing team is like, oh my God, how are we going to hit revenue targets if they're cutting our budget in half? And then the marketing team doesn't know how to counter, and they're like, oh, but we won't hit revenue targets. And we're like, well, the CFO goes, well, we have to. And then that's kind of it. And then the business fails for Q1. What is the actual solution? Like, how do you middle ground that and fix that whole problem? The middle ground solution is that we need to find the point in which we're willing to drop our efficiency to sell through enough inventory to get enough cash back in the business. And so the answer usually isn't, oh, we need to go from our, let's say 20% MER to down to a 10% MER. But instead, we need to go from a 20% allocation to marketing to a 40%. We need to actually crank up and drop efficiency, but it's going to allow us to increase sell-through rate and move a lot of this inventory back into cash. Yes, we're not doing it very profitably. Yes, we're not maximizing EBITDA percentage, but we are going to get more cash back on the balance sheet so that we are in a healthier position. And then the marketing team can obviously adjust their KPIs. Their volume target goes up, their efficiency target goes down. And then they can resolve that issue in the business. But if it's just purely like hey, profit needs to go up, it's unrealistic, particularly in that sales environment of Q1. And so the business will get nowhere and everything will just get spiraled downwards.
There's a great example that we've actually just onboarded that is sort of the other way. Because I think it's also important to talk about when as a business potentially been a little bit not too conservative, but a business that's operating conservatively and is a very, very healthy, profitable business and cash flow positive business. But perhaps a good conversation to think through, how do we think about, or what are the right questions that founder or operator should be thinking about in terms of how do they scale a little more aggressively while still staying a really healthy business. So this is a single product, 7-figure brand that we've just started working with this week. They are very cash flow healthy, and they have, through large swaths of last year, run at an LTGP to CAC of between sort of 6 and 8. So incredibly profitable on acquisition. Actually, like a brand, they're like, we've been pushing, we want our agency to spend more money. And that's ultimately why we're now working together, is we know the team will be able to help them do that. But what are the questions that you're keeping in the back of your mind as an operator and thinking through what is an acceptable like erosion of efficiency to really scale while still staying a really healthy and profitable business?
I think there's two important disclaimers here. Number one is that when you're operating at such high efficiency, like an 8 LTGP to CAC, there is an ability for an agency to come in and say, oh, you're so profitable, we should just crank. And then they just crank up media spend and your revenue doesn't really move much, but they dilute down your efficiency to like a 3 LTGP to CAC. And they go, now you're within the bounds of normal. Most people operate here. But now you're just spending a bunch more money and you're not actually getting GM profit contribution. And that's very common because when you see high efficiency at low ad spend, normally the ad spend is not the entire driver of the revenue pie. It might be driving like 50%. And so the LTGP actually isolated on media spend to conversions isn't as good when indexing against the whole business. So that's just like the first caveat. You just want to make sure that as you're incrementally layering in spend, revenue is obviously going up proportional. There's obviously going to be diminishing returns there, but that's important. Number two, and like tying into the actual topic of this podcast, is when it comes to free cash flowing to fuel growth, you can calculate exactly what that looks like. I actually have a video on the Blue Sense channel with Bell from maybe a year and a half ago. It's called Max Growth Rate Calculator or something like that. But a function of how fast you can grow is a function of how much free cash flow do you have to buy more inventory. And so if you have a really good marketing function and a really good product, the actual limiter within an e-commerce business is your ability to buy future inventory. Because if you just simply, like the example is if you sold, and I think anyone with a large retail or e-com business knows this, but if you bought 10 t-shirts and then you sold the t-shirts and you made $50 in gross profit, that will only allow you to go and then buy 11 t-shirts on the next one. Unless you get cash from somewhere else, unless you have funding, unless you go and get loans, you are literally limited in growth by how much profit you are making in the prior month to then buy the future inventory. And so you can calculate that. And what ends up happening is the actual biggest limiter on growth rates, assuming CAC is stable, is your cash conversion cycle. And so if you have a long cash conversion cycle, it can be the difference between you growing by, and this is like, if you have a 90-day versus a 30-day cash conversion cycle, this is the difference between your potential growth rate this year being 10% and like 600%. It's that much of a difference because it compounds every single month. So having good terms with suppliers so that you can float cash more easily is a massive unlock for growth, assuming that you can rapidly increase media spend and maintain efficiency.
And I think that's where, like, again, like the transparency with your agency is so important, right? Because a lot of founders that I speak to the first time, they're like, why do you need all of this information? Because it's like, in many ways, it's like quite sensitive information about their brand, right? And so obviously privacy is extremely important in that conversation. But you talk about a brand that is, I've spoken to brands in the last 6 or 8 weeks that were, you know, placing a PO with a 4-month manufacturing time that they're paying 50% upfront for. So their cash conversion cycle is just biblically bad. It's really going to struggle versus a brand that's paying for it all on delivery or manufacturing. Yeah, a lot of brands that like are still doing their own manufacturing onshore in Australia, perhaps at a slightly worse GP, but they're able to like liquidate that cash way quicker because of that. Like, how does that, like, there's obviously a margin conversation that comes into that.
Yeah. Well, I think this just like speaks to the complexity of the e-com business model that isn't as easy as people make it seem when they just have a daily profit sheet and they say that like net profit up good, net profit down bad. Like, because I think it's important for if you're looking to rapidly grow and we can maintain efficiency, or at least the erosion in efficiency isn't that bad as you continue to scale, it's obviously important for us to know when we're putting our forecast together, what kind of growth rate can you predictably cash flow? And then are you going to go and leverage like loan facilities to be able to accelerate that growth? And that's kind of important for us to know, because if you're going to, and I would say this is really important for us to know, because if you're going to go and take out loans to be able to fuel future growth based on us personally achieving that growth for you through media spend, God, I want to be certain that we can achieve that growth, or else you're just going to wipe out your profit and interest payments, and you're going to put yourself in a very high stress environment by having that much debt. And I've been in this position before. I've been in a position where a brand has literally said, "Oh, we want to grow by 200%," and I've been like, "Look, that's kind of crazy, but here's what the media spend would have to look like to achieve those numbers. Here's what the efficiency would have to look like. I don't think this is very likely, but if this is the path that you want to go down, this is obviously all the inputs that we would have to execute on." And then they've gone and taken like a $2 million loan to execute against that forecast, and it's like I didn't sign up for that at all. But that's one of the things you'd learn, and it's one of the things that I think a lot of agencies would have no idea that they're actually causing those implications on businesses. I think that people would be shocked, performance marketers working at agencies, when a client has said, "Hey, can you give us a realistic forecast of what kind of growth we can expect?" And then they come back naively and go, "Oh, we can triple this year, or we can double." And then the client goes, "Oh, amazing, cool, thank you." And then secretly goes and takes out a $250,000 loan to facilitate your inventory payments and the agency fee and then the ad spend. And then they don't hit the targets, and then it absolutely cripples the business owner. But the business owner doesn't actually communicate that to the agency, either out of privacy concerns or either out of like, I don't want them to know that I'm going into debt or whatever it might be, or just the performance marketer doesn't seem very competent, and they're like, what would they do with this information? Like, what would even be the point of me telling them this?
Well, and I think there's a conversation here that I've had a few times over the years, before my time at Blue Sense, that like often, so these brands that tend to start using these lending products, perhaps irresponsibly, I feel like irresponsibly maybe is a bit harsh of a word, but it's effectively what we're talking about, are your brands that have got to like 7 figures, maybe even high 7 figures, because they've caught fire with a product or two and it's growing well. When you get into the mid 8-figure range, you're typically talking about brands that are a lot more financially competent because they've been able to achieve a certain level of scale. And certainly when you're beyond that, you've got a really competent CFO in the mix as part of that business. That sort of mid 7-figure range, though, where you tend to see a lot of this lending, I feel like the challenge is, one, often the owner or operator of that business, most of their experience around financial instruments is personal. It's mortgages, car loans, credit cards, which is very, very different to business finance. And then when you look on the agency side of the fence, it's usually a young performance marketer that's probably in their mid-20s, that probably their experience of just money in general is like, I have a credit card that has a limit that's like single digits, thousands of dollars. And there's you physically can't comprehend what a $250,000, much less $2 million loan is. Like, it's a fundamentally incomprehensible amount of money for that person's worldview or experience. And so that's where the competency of an outside fractional CFO, a agency advisor like Blue Sense, is so important. Is there, beyond saying like you should do an economics or finance module at B school, like is there like a core fundamental that you'd think of there for the owner or the founder that's in that sort of area?
I think learning stuff is actually pretty easy these days, which is you go to YouTube, you search for the stuff that you want, you watch some content, and then whoever you learn the most of, you contact them and you say, can I pay you for 3 hours of your time, 1 hour a month for 3 months? And then that individual that you learn the most off now becomes a mentor for you for 3 months where you can learn everything. That's how I've always learned most of the stuff that I've learned. It's like, go to free content, and then if they're absolutely incredible and you have specific questions for them, normally if you just DM them or comment it, people answer. Like, I answer DMs all the time, and I'm not charging for it, but that's how I would learn everything. Like, I I have a lot of finance knowledge from actually doing a degree in finance, but I would argue I've learned more from pre-resourcing.
Yeah. Great. I mean, to close off this topic then, I think the core one that I think as it pertains to paid media is a conversation we see all the time, which you touched on a few minutes ago, is that like the business is heavily in distress. We're going to massively ramp ad spend down, which is usually where the spiral starts. The devil's advocate to that is, Nathan, you own a paid media business. Of course you'd say that. So in like, what's the closing take there of like, how should brands be thinking about protecting their P&L and their balance sheet while still being mindful of paid media needs to sit fairly high up the priority list in that very specific scenario?
Well, firstly, we don't build percentage of ad spend, so you can trust us.
So that helps.
Fair enough. If you're getting billed percentage of ad spend and they're like maintain spend high, I would also be concerned.
Yeah.
But well, the crux is that you need to. The reality is, no CFO would ever say that to us because they have a very, very strong understanding of the incremental impact of every single dollar getting layered on to the total ad spend amount and what it is driving back. And they are unbelievably confident in it because we are not using an arbitrary ROAS read. We are not just throwing together an MER number. We will, in large businesses where applicable, run geolift experiments to get real incrementality reads across each region and then apply an incrementality factor to whatever we're looking at. And the CFO is run through exactly the methodology as to how that works, why it works. They're on board so that when they come and they go, oh, this is not a good position, we need to cut media spend, they can be confident in going, well, if we cut 20% of media spend based on the recent lift studies you did, we're probably going to lose $1 million. We probably shouldn't do that. That's probably not a good idea. We need to cut costs elsewhere, or we need to increase media spend under an assumed incremental ROI, which we probably already have. They already probably have a very good gauge of which platforms we would push for certain returns. And then they have to cop a lower efficiency for that month to just move more stock.
Mm-hmm. There we go. Thank you very much, Nathan. We'll leave it there. If you guys have questions about how to actually operationalize all of this in your business, the details will be in the description. We would love to help you out. Thank you very much, Nate.